Hey everybody, it's Shelly Hoffman, and today I am with Rob Just. He may look familiar to you. Rob has done quite a few interviews for PAC-B, giving us some market updates. And then, when COVID hit, Rob, you came on, you kind of told us what to expect, what the government was doing for us, what it did to the market. So I just kind of want to touch base with you again and see where things stand now. How are you been?
Good. Thank you. And pleasure to be on. Thanks for having me.
Of course. So what can you tell us? What would you say let's start with maybe something positive. Like what is something good going on, Rob? Because we certainly get bombarded with bad a lot.
Yeah, well, as crazy as it sounds, there are a lot of positive things. And last week I was kind of looking back over the last 6 months, 7 months, and looking as to where we started before the pandemic. And I was saying, okay, let's go back 12 months. If you and I were having this discussion 12 months ago, and you were to say to me then, all right, Rob, where's the market going to be 12 months from now? And these are the things that are going to happen over the next 12 months. We're going to have the Fed cut rates to zero. Gold is going to be up 35%. Market volatility is going to be double and at times quadruple. Unemployment is going to go from a 75-year low of 3% up to 15, 16%. Oil is going to tank by 70%. And the GNP and GDP is going to go down by 36%. I would have said, I don't need any crystal ball. Market will be down 30, 40, 50, probably even 60%. Boy, would I have been wrong. Okay. Now, if I had said the market's going to be flirting with a new all-time high, you would have probably said, all right, Rob, put the drugs down, get back. But that's where we are. We're positive for the year, 3.5%, almost 4%. And it's just unbelievable. You look back and it's, you can add all these adjectives about the year or what happened, but the one I like the most is unprecedented, because the start of it, everything we've been through has been unprecedented. The recovery has been unprecedented. And I say it's Wall Street and Main Street disconnect. Wall Street's been saying one thing, with all the bad news and unemployment and everything, but Main Street's been saying something else. And here we are now, by all means, not out of the woods yet, but the market is up. We're not that far from a high. It's been crazy. It's been crazy. And so a lot of that has to do with, we talked about that back in April when we got together, and even before that, is that this recession has been caused by the pandemic. Okay. The recession back in 07, 08, that was something brewing for a year and a half, 2 years. Okay, that was an economic issue. This was a medical issue that turned into the economic. So coming out of it was going to be a lot quicker. A lot of the experts said, the government just reacted like that, just so quickly. They've had 11 packages, whether it's the stimulus package or them buying bonds in the open market to create liquidity. It's just been unprecedented. Back in 07 and 08, they took about 3 or 4 months before they started their stimulus. This was immediately. That had a lot to do with the recovery. Now, going forward, that's probably your next question. What can we expect? Who knows? Your guess is as good as mine. But back to your original question about what positives. Now, who would have thought everything would have been shut down? The economy, everything. Okay, but we look at now. Yes, unemployment's still high. It's about 10.5%. We started at 3. Okay, come down from 16, but still 10.5. A jobs report came out this morning, and it just blew expectations away in terms of new jobs. So that's a positive. Things we've seen in the marketplace is that consumers have been continuing to spend. Right. Okay, they're increasing spend. Okay, May, June, consumer spending almost doubled. Okay, You look at UPS, you look at Amazon. We've just coming out of the peak earning seasons where a lot of companies are giving their earnings for the quarter, and a lot of the logistics companies like Amazon, the freight companies, they had great earnings. Typically, this is a good sign that we're coming out of the recession because people are spending. Personal savings rates. This is something where prior to the pandemic, we were at all-time highs for the U.S., 8%. Pandemic hit, April, it flew to 34%. People weren't moving their money. They were keeping it. They were getting their stimulus check and just hoarding it, keeping it in the bank. May, it dropped to 24%, June 19. So people are starting to spend, move their money. Housing's up drastically, 13, 15% on a year-to-year basis. In the Northeast, home sales were up 54% for the May-June period, and Northeast was hit the worst for the pandemic. So these are positive trends. These are positive signs that we see. Not to be too rosy, some of the negatives we see is there's some major gridlock going on right now with the next stimulus package. Like I said, unemployment is still a little bit high.
Rob, can I ask, are they planning on doing another stimulus? Like where does that stand, I guess? You're saying gridlock, but what does that mean?
Well, that just means you have the two sides. The Democrats and Republicans are fighting over it. Everyone wants their agenda. Everything wants something in there. Democrats gave their package. Republicans tweaked it, looked at it. Right now, it's at Congress. Okay, so it's not far off. There will be concessions. Both groups will definitely agree on something. We're probably, within 2 weeks away from another one. Okay, so it should come through then. Everything I've seen on the initial, there's going to be another stimulus check to families, same amount, same criteria. There's going to be more money. Now, this is going to be another $1.5 trillion, almost $2 trillion package. There's going to be more money to come down into the local governments, local municipalities, the states, small and medium-sized businesses are going to get more money. So once again, that could be a positive going forward, that more money's reaching the places that it didn't really reach before.
So again, this goes back to, you're an expert on what you're talking about, but you may not be able to answer this, but what goes into my mind is if the government's giving, another stimulus check or money to the businesses, is that a long-term good thing? Or is that a short-term good thing that's going to have repercussions later? And I know I asked you this back in April, but now the same question's coming into my head again. We're a little bit of different.
Right, and that's a very, very good question. And I'm going to answer the answer and say both. It's good and bad.
Good job, Rob.
It's good because, those stimulus packages got us to where we are today, helped us get out. Okay. Long term, it's going to add to the deficit. So what's going to happen with the deficit? Is all this money coming into the economy going to lead to inflation? The Fed has come out and said they're leaving rates close to zero for the next 2 years. But because of all this money that's in the system, we're probably going to see some increase in inflation next year. Nothing drastic, not out of the ordinary, but just an increase from where we are now. A lot of it's going to taxes. Someone's going to have to pay for this. I could easily see taxes being raised eventually to help pay for it. If the Democrats get in, Biden has said he wants to increase the corporate tax. It was cut back in 2017 down to 21% from 35 and 28. Biden wants to raise it to 28. What effect is that going to have on these businesses that now are starting to ramp up production? Like everything else, it's going to have some negative. It's going to have some positive. I think short term, I think they're really positive because it'll jumpstart us like it did a month or 2 months ago.
Okay. No, I can appreciate that answer. You had brought up the economy back in 2007, 2008. And as you know, I care a lot about the housing market. Right. And, in Beeville, things are going, 20,000, 25,000 over even list price, which has me concerned. And then when you add the increase in taxes on top of that, my fear comes back, and I know you're, more into the market itself, but real estate plays a part in that as well. So I'm just, like everybody else, sit back and kind of see. But the more that I'm seeing the price of houses go up over even, list price and things like that, and then you're talking about the taxes, what's that going to do to the people who are paying so much for the homes? And that's a question for another conversation, but I'll probably get somebody on here to talk about that, because I'm definitely interested in what that's going to do. So what else has been going on? Not to interrupt, something else.
If you look at the stock market, okay, and you look at two things. I look at the stock market and I look at the bond market, okay? A lot of looking forward, stock market, I think, looks a little murky, okay? You go back 100 years and you look at the stock market and you can break it up into 10-year periods, almost with the decades. We just finished the 2000s, 2010s. It was a great 10 years in the market. Unbelievable. Greatest bull market we've ever had. And the market was basically raging since 2009, since coming out of the recession. You look back, and history has shown us is that after a great decade, we usually have a somewhat muted decade now. So, could that be something going forward? Something to look at. Every model I'm looking at in terms of valuations has the U.S. stock market being somewhat overvalued. Okay, not at the level we were at in 07 and 08, which those valuations were off the charts, but it is a higher valuation. So going forward,
can you explain what that means, Rob, to people that maybe not understand what overvaluation? What does that mean?
Overvaluation basically means the price of stocks are going up quicker than their earnings. Okay. Is basically what it is. So as prices inflate, prices go up, earnings aren't going up as quickly. So a lot of experts say, well, there's nothing that's going to sustain these prices because the earnings aren't following. Okay. Now, once again, we're not that off the charts. We're just a little bit overvalued, but it is something to keep an eye on. International market is undervalued compared to the rest of the world. The foreign markets are very undervalued, especially the emerging markets. Okay, so that's a place going forward I would look to increase your holdings if possible. If you want, you'll take a little bit more risk, but I think long term you'll be compensated for that. Other thing that we've noticed, and this has been going on for the last 15 years, is growth stocks. Technology companies have been far outpacing value stocks. Value stocks being stocks whose prices are lower compared to their fundamentals, their earnings, et cetera, and so forth. Now, we've never seen this type of disparity ever as the past 10, 15 years. If you look at the rebound we just had from March 24th, I think it was, to mid-July, growth stocks bounced back 54%. Value stocks came back about 39%. So that's a 16%.
Rob, can you give an example of a growth stock and a value stock? Because again, if somebody's not familiar with those terms, they're not sure what companies would qualify for those.
Your growth stocks or your look at any of the technology companies, the Amazon, Netflix, Apple, Microsoft, okay, any of those. Typically, they're companies that they may not have been around for the last 50, 100 years, okay, that they're just really rapidly growing. The value stocks tend to be your older, traditional companies that typically pay a little bit higher dividend, okay? Historically, it's been your large Lockheed Martin, Mobil, Exxon, IBM. Now typically a lot of your financial companies are your values. Okay. Once again, the price is trading less than a lot of the fundamentals say they should be. Okay. So that's something to look forward going forward. In the bond market, the one thing we've seen is that's recovered nicely. Back when all this mess was going on, the first half of this year, we had strong performance. Everyone was leaving stocks. They were going into the low risk bonds. Okay, so they did well. The low risk bonds like treasury bonds from the government, high rated municipal bonds, high rated corporate bonds. Okay, they did very, very well. With interest rates being so low, you're not getting the income from bonds. So people who need income have to look other places. The dividend yield on the S&P 500 is right around 1.9 right now. 10-year treasury is 0.5%. So you're better off in stocks if you need income. And I think that's something that could drive stock prices over the next 10 years. So if I think the main theme, whatever you're looking at, whether it's stocks or bonds, look at quality. Okay, good companies, okay, good bonds, good stocks that can weather the storm. A lot of this recovery, unfortunately, is going to depend on the non-economic issues, but more the medical. Are we going to get a vaccine? Are we going to see therapeutic drugs come out to lessen, the spread, and if you do get it, lessen the the duration of having it. So a lot of that's going to depend on that. So I would look, in the stock, I would look international, I would look value. Be careful. We still could see some bumpy rides. In the bonds, I would look at lower maturities, lower, shorter bonds, high quality corporates, treasuries. I would look in the municipal market, which are tax-free bonds, especially if money is coming down to the municipality level. That could help that. And also, I would look at bonds that are what are called inflation protected bonds in case we do have a spike. Typically, those are bonds that have a little kicker in it to pay you more as inflation goes up.
Okay. I mean, and obviously we've said this before, it's always important to get, I think one of the first interviews you did, you said people always go to the doctor for their annual health evaluation. And it's really important for your wealth evaluation too. And especially in the time of pandemic, because things may change because a lot of people's financial situations have changed a couple different times throughout probably the last 7 months. So it's important to gather the information, but talk to your financial advisor. That's what you guys are there for, is to kind of guide you through the systems and the changes and whatnot. Is there anything else?
Even if your situation, even if you weren't directly affected by it, both spouses have continued to work, whether it's at home or wherever, so it's still coming out of anything like this, it just helps to talk with your advisor, talk with somebody, just to get another opinion, because there are these other avenues. Things are changing. They're typical investments that a year ago were fine, may not be, especially if you're looking for the income or you want to lessen risk. That's the big thing, is typically coming out of any crisis like this, people want to scale back their risk. And if they just leave everything as is, they haven't done that. Yeah. Okay. And, the big thing I would also profess is that make sure your allocation, meaning how your investments are allocated, match your goals and your risk. That's the big thing here. So if the market does come down, your portfolio comes down, you're ready for it. I can take the risk. I don't need it for 20 years. So you don't panic. So that's the big thing. And to reiterate what you said, talk with your advisor.
Yeah, and figure it out. So, well, is there anything else you would say before we end this call that you think the community should know, not just about the pandemic and its changes, but the market in general?
No, I would just reiterate what I said is look at these other areas that you may not have been invested in, like the international. Like the value. The international is a great example, because we tend to have what's called domestic bias. Most people in the U.S. have 80% of the portfolio in U.S. stock. Now, if you look at the world market, the U.S. is made up of about 55% of that. Okay, so most people are underexposed because of this domestic bias. We live in the U.S., we're more familiar with the companies, et cetera, and so forth. Yeah. The other thing is, the last 10 years, U.S. stock have grossly outperformed international stock. And most investors tend to look at what just happened instead of going forward. Well, you throughout the last 10 years, you look at the last 100 years, and international stocks have outperformed US stocks pretty routinely. So we've got this bias for US because we live here and because we're kind of just looking at the short-term memory of the last 10 years. So talk with your advisor about increasing your international exposure. Also talk with your advisor about adding other areas into your portfolio, maybe some real assets, some real estate, some commodities, some gold. That will help you on when the markets come down, your portfolio won't come down as much. So I would definitely, good time to talk about all these areas. And if something you're not investing in, you may feel uncomfortable, just start very small. But in the long run, that it'll help you.
Well, that, as always, that's really good advice. I do want to throw in before we part ways that Cindy did chime in with a good morning and to say congratulations on your new grandbabies, which I wasn't aware of. So congratulations. I hear you have some, right?
My son and his wife had twins back on June 2nd. They were 12 weeks early, so they've been in the hospital. They just came home this past weekend. So got to meet them for the first time.
Very nice, very nice. And I apologize because we actually did talk about this, and I wanted to share one little pandemic thing about this. And in the hospital, everybody's been told that only one parent can visit, but I guess your family had a little bit of an advantage, correct?
And that's funny because at the beginning, and back in June when they were born, the rule was, like you say, one parent per child in the intensive care unit. And you had to designate that parent up front. So it was one parent for the whole time they were going to be in the hospital. And they knew they were going to be in the hospital 8 to 10 weeks. And so, the first night they're visiting up in the intensive care, and the nurse says, well, we've got good news. We've got a little bit of a loophole here. You've got 2 babies, so you both can visit.
Which is nice, because I gotta be honest, I couldn't imagine, how do you make that decision, when you have one baby, which parent it's going to be. So congratulations on your grandbabies, and luckily, like you said, they both could go and visit. This is a crazy time, Rob. The more I hear about stories. So I gotta believe I'm probably going to talk to you in the next month or two again about the stimulus packet when it comes out, and and the effects and stuff that it has. But I appreciate the information and your time this morning, and I'm sure we'll touch base again. Enjoy the rest of your Friday.
Thank you, and as always, it was good talking to you, and thanks.
Sure. Bye, Rob.